It's crap. It's just crap. It's like you buy stuff for $5, $1, direct from the Chinese factory, super cheap stuff. It's junk. And the users are now have figured it out. Monthly active users are down 40%. Revenue is down 39%. And our CEO and founder, by the way, is resigning and stepping down. It's just so many things about this thing just don't make any sense. Wish, since going public, has crashed 74% since going public last December of 2020. And now the CEO is transitioning. So they started out, and I have the transcript of their quarterly earnings call. And so you start out the call, you can see here the transcript, and you can see the participants on the transcript, and you're reading through it. Executive chair, 2 interim CFOs, and then a new CFO. Like, what? Excuse me? The chief product officer and the chief technology officer are also brand new to the company. So is clearly this CFO. But there's no CEO on the call. And that is because right before the earnings call, they said, yeah, here are our earnings. Our earnings are absolute trash. Our monthly active users are down 40%. Down 40%. Yes, that's correct. And our CEO and founder, by the way, founder and CEO, is resigning and stepping down. Their revenue is down 39%. Ooh. And basically, for the upcoming quarter, they basically didn't give guidance and said it's going to be worse, right? That revenue is going to be down. A good case scenario would be for revenue to be down 39%. They said we actually can't give guidance, but we don't think it's going to be any better, which means it's going to be worse than this current quarter. Yeah, that was this earnings call. So let's just go in the Wayback Time Machine. Let's look at a couple of videos we did on Wish. This was one of the first videos we put out. This was September 2020. Why I'm staying away from the Wish IPO. That was earlier, right? And then, they went public. This was now November 24, 2020. This one got much more views. And I really clobbered them in this. I said, Wish IPO, something's fishy. They are classifying this logistics and fulfillment revenue as revenue. They're kind of conflating the take rate that they get from the marketplace with logistics revenue, this kind of bundled service offering. It was very bizarre to me. And to me, I saw it as a way for them to inflate their revenue numbers, trying to just be able to point to a much bigger revenue number than they should be able to point to. Why they were considering it logistics revenue, I don't know. I still disagree with the conceptual approach behind it. And again, it felt like the company was grasping for straws. I never liked the positioning, this stuff, and we'll go into their earnings release. But what Wish is, if you don't know what Wish is, it's a marketplace with 97% of their sellers are basically just Chinese factories. They're just selling you crap. It's crap. It's just crap. It's like you buy stuff for $5, $1, $10, an iPhone case for $1, right? It's just junk coming directly from these Chinese factories, just producing junk, shipping it across the ocean. And that's the model, which I was very skeptical of for a variety of reasons, definitely one of which was including the Chinese exposure risk. I mean, that was before now all the supply chain stuff, which they actually weirdly, management in the earnings call downplay the supply chain issues. Also very weird. So anyway, let's look at some of the excerpts from their transcript here. The founder is stepping down. He made a personal decision that now is the right time to step away from the business. Yeah, because the business is crap. I mean, the guy made a lot of money for himself, but this is not a business you'd want to invest in. Okay, here it is. 2 key pillars of our strategy to return to growth are as follows. Increase user confidence in our marketplace and to provide a more differentiated and engaging user experience. What do they mean by increased user confidence in our marketplace? They go deeper into it here. We announced a new program for our merchants called Wish Standards, which is designed to reward merchants that consistently provide an exceptional user experience. And you're like, user experience? What does that mean? How would the merchant have anything to do with user experience. And then it comes out. While we evaluate merchants across performance metrics, we provide the highest performing merchants with priority placements. Basically, the thing is this word right here. We evaluate merchants across performance metrics such as product quality. And then she lists a bunch of other things which are not the real thing. The real thing is product quality, which is they want to get higher quality merchants. We've also increased our efforts to proactively prevent, detect, and remove misleading, fraudulent, or poorly reviewed and low quality product listings from the prep. It's just a bunch of crap. That's what this thing is. Crap in, crap out, direct from the Chinese factory, super cheap stuff. It's junk. And the users are now have figured it out, and their churn is through the roof. And now they're rolling out standards and quality programs because, oh, surprise, surprise, this is just a bunch of junk. And our repeat order numbers are probably abysmal. And then the second point is we're making progress in reinventing our shopping experience to make it more encouraging and entertaining and easier, run-on sentence, for our users to purchase products they love. We're experimenting with live video. And we just did a deal with Klarna. This is like hilarious. Wish users in the US have the flexibility to spread the cost of their purchases over 4 interest repayments. Why do you need Klarna when you're buying a $5 iPhone case? Really? This is the magical experience this management team has cooked up to reignite growth? What a joke. What a joke. I mean, it's laughable. And it just goes on, just grasping for straws. This thing, it's going to keep going down. What is the current valuation of this? Oh my. Oh my. Look at this. This thing is still a $3 billion company. $3 billion company. Are you kidding me? This company is worth $3 billion. This thing should go way down. It's nowhere near the bottom. This thing is still high. They're hemorrhaging money. This is the weirdest part. Despite global supply chain shocks during the quarter, we were able to reduce our delivery times and improve our on-time rate. And it just also doesn't make any sense. The stuff is coming from China. You can't get stuff into the docks. But they're reducing their delivery times? It's just so many things about this thing just don't make any sense. What a boondoggle. You know, at least they're not committing securities fraud. Well, you know, based on your interpretation of logistics revenue, that's still up for interpretation, in my opinion. But at least they're not as bad as a Luckin Coffee or the Chinese tutoring platform, which we covered on the last episode, which is deliberately defrauding investors and management selling all their shares without everyone knowing. That's a very low bar to compare them to, but still, no way this thing is worth over $3 billion. Not a chance. Hi, I'm Alex. Thanks for watching the show. Make sure to hit that subscribe button, but even better, make sure to follow us on Odyssey, follow us on Rumble, and text us 203-646-5159. Text the word Monopoly. You'll be subscribed. You'll get updates about when we're going live, our latest videos, and we'll send you even a little goodie bag. And in the event that we all get banned from big tech, we'll still be connected.